Have you ever wondered how the 2025 U.S. commercial real estate market is shaping up amidst a backdrop of elevated interest rates and geopolitical tensions? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. The U.S. commercial real estate market in 2025 presents a landscape of contrasts where resilience and fragility coexist. According to Albert Fox, sectoral duality is evident, with industrial and logistics sectors showing strength, particularly in the Sun Belt retail space. Meanwhile, office and urban hospitality sectors continue to lag. Prime office assets in cities like Manhattan, San Francisco, and Washington, D.C. are benefiting from hybrid work adoption, contrasting with underperforming Class B and C properties suffering from outdated infrastructure. In the industrial sector, there's a clear flight to quality, with demand for modern logistics facilities rising due to reshoring trends in manufacturing and pharmaceuticals. However, the sector faces challenges with elevated construction costs and material shortages. Despite a 4.6% quarterly decline in pricing in the first quarter of 2025, investors focusing on best-in-class assets in strategic locations could see significant long-term value appreciation. Retail markets in the Sun Belt have shown surprising resilience, driven by population growth and the resurgence of in-store experiences. Power centers and neighborhood malls are thriving, with strong rent growth and adaptive reuse opportunities. For investors, focusing on markets with strong demographic tailwinds and phygital integration capabilities could prove advantageous. The multifamily sector is stabilizing, with Class B properties leading the way in high-growth Sun Belt markets. Despite high interest rates and slower economic growth, multifamily remains a top investment target due to its strong fundamentals and sustained investor interest. Strategic positioning involves balancing exposure to high-growth areas while being cautious in overbuilt urban centers. The hospitality sector has seen a strong rebound, with leisure-focused markets like Hawaii performing well, though urban properties continue to lag. Average daily rates and revenue per available room have exceeded 2019 levels, but overall occupancy remains below pre-pandemic norms. Investors might find value in targeting leisure destinations and hybrid-use properties. Overall, the 2025 U.S. commercial real estate market is defined by duality, with sectors showing resilience alongside others facing fragility. The key to success lies in aligning capital with structural trends like the shift to quality in industrial, the demographic momentum in the Sun Belt, and the redefinition of office and retail spaces. While macroeconomic uncertainty persists, a strategic sector-specific approach can unlock value in this divided landscape. Let's shift our focus to New York City, where the commercial real estate market is navigating a pivotal inflection point in 2025. This is largely driven by a confluence of post-pandemic recovery, shifting work patterns, and a wave of billionaire-led strategic acquisitions. While broader economic headwinds loom, such as a $2 trillion maturity wall of commercial mortgages over the next 3 years, New York's most resilient asset classes are emerging as discounted opportunities for investors with deep pockets and long-term vision. Notably, investment in New York City's commercial real estate has totaled $13 billion in the first half of 2025, with over 50% of the dollar volume concentrated in the fabulous four asset classes: Class A and trophy office buildings, free market multifamily, affordable housing, and retail. Class A and trophy office properties alone accounted for 74% of the $3.1 billion in office sales, driven by strong tenant demand and equity surges. This trend is underscored by institutional players like Blackstone, which recently acquired a $644 million stake in Fisher Brothers' 1345 Avenue of the Americas, a prime midtown office tower. Meanwhile, the conversion of underutilized commercial spaces into residential units is reshaping the market. CBRE projects that in 2025, the volume of office-to-residential conversions and demolitions will surpass new office construction for the first time in history. For instance, the transformation of 25 Water Street into 1,300 apartments reflects a broader pivot toward multifamily housing, which saw $4.4 billion in sales in 2025. with free market properties dominating 57% of the volume. High net worth individuals and institutional investors are capitalizing on discounted opportunities amid the market correction. Billionaire Ben Ashkenazi, for example, raised $750 million to target over-leveraged retail and hospitality properties, acquiring the shops at Atlas Park in Glendale, Queens, for $750 million, a move signaling confidence in repositioning underperforming assets. Similarly, Extel Development's purchase of 655 Madison Avenue, a 24-story office tower slated for conversion into luxury housing and retail, highlights the trend of repurposing commercial assets in Manhattan's most desirable corridors. The luxury residential market remains a magnet for ultra-high net worth individuals. Data from the Douglas Elliman and Knight Frank Wealth Report indicates that 25% of American ultra-high net worth individuals plan to buy a home in 2024, with New York among the top U.S. luxury markets. Manhattan's luxury condo market saw a 29% increase in apartment sales in the first quarter of 2025, driven by record Wall Street bonuses and all-cash transactions, which accounted for 90% of sales above $3 million. As the U.S. dollar weakens against currencies like the euro, British pound, and Swiss franc, New York's real estate is becoming increasingly attractive to foreign buyers. A Forbes analysis notes that Manhattan resale condo prices hit a new high in 2025, while Brooklyn's new development condos offer significant foreign exchange discounts, making them a strategic entry point for international capital. While the market's resilience is evident, challenges persist. Deloitte Insights highlights that elevated capital costs and loan refinancing risks remain critical concerns, particularly as central banks begin to ease monetary policy unevenly. However, the fabulous four asset classes, especially Class A office and multifamily, offer a buffer against broader economic uncertainties. For instance, J.P. Morgan's $3 billion investment in its 270 Park Avenue headquarters underscores continued demand for premium office spaces, with occupancy rates exceeding pre-pandemic levels. New York City's commercial real estate market is at a crossroads, with discounted opportunities emerging in prime assets as billionaires and institutional investors deploy capital with surgical precision. The interplay of conversion trends, international demand, and strategic repositioning of underutilized properties creates a compelling case for investors willing to navigate short-term volatility. Endurance Real Estate Group has successfully executed a full building lease at the Chambersburg Logistics Park with a national third-party logistics provider. This newly developed Class A facility is located on 93 acres directly off Exit 10 of Interstate 81 in Chambersburg, Pennsylvania. The project's prime location, along I-81, and its state-of-the-art design were pivotal in attracting a leading logistics provider to lease the entire 1,006,500 square foot development. The southern I-81 submarket has become a thriving industrial hub over the past decade, drawing tenants due to its superb transportation infrastructure and skilled labor pool. Endurance Real Estate Group identified the site off-market and secured necessary land development entitlements, crafting a best-in-class site layout to appeal to large-scale logistics users. The facility features modern amenities such as 40-foot clear heights, LED lighting, and an ESFR sprinkler system with extensive dock and parking capabilities. This strategic location offers full visibility from Interstate 81 and connectivity to major highways like I-76, I-70, and I-78, providing access to East Coast markets, seaports, and various transportation systems. It's situated within 10 miles of Norfolk Southern and CSX intermodal yards and close to FedEx and UPS facilities, enhancing its appeal to logistics operations. Endurance Real Estate Group, based in Radnor, Pennsylvania, focuses on industrial opportunities in the Mid-Atlantic region. Since its inception in 2002, the company has acquired and developed assets totaling approximately $1.8 billion. Their current portfolio includes 57 buildings and ongoing projects that expand their distribution capabilities. Shop-Off Realty Investments has successfully sold the final parcel of a 14-acre neighborhood shopping center, concluding a series of dispositions that total $58.8 million. The sale marks the completion of a strategic divestment process for the company, showcasing its ability to execute on its investment strategy effectively. The 14-acre site, which has been a focal point for Shop-Off Realty investments, was meticulously planned and developed to optimize its value. Through a combination of strategic leasing and property enhancements, the company was able to maximize the asset's appeal to potential buyers, ultimately achieving a favorable sale outcome. This disposition is part of Shop-Off Realty Investments' broader strategy to capitalize on market conditions and redeploy capital into new opportunities. The sale of this final parcel highlights the company's adeptness in navigating the complexities of the commercial real estate market, positioning itself for future growth and success. In the context of the Canadian market, particularly in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, there are similar opportunities for strategic property dispositions. These areas have seen a growing demand for well-located retail spaces, driven by population growth and urban expansion. Investors in these regions are keenly watching market trends, seeking to capitalize on potential value gains through strategic acquisitions and sales. Comparatively, in the United States, the retail sector continues to evolve with a focus on experiential and mixed-use developments. As seen in the recent Shop-Off Realty Investments deal, there is a strategic shift towards optimizing retail assets to align with changing consumer behaviors and market demands. This trend is mirrored in both countries, offering cross-border investors insights into potential opportunities and strategies. Connolly Brothers Inc, a prominent construction management and development firm, has acquired a 160,000 square foot office building at 75 Sam Fonso Drive in Beverly, Massachusetts. This acquisition is located within the Cherry Hill Industrial Park on a 38-acre parcel, marking a significant investment in the North Shore's commercial real estate market. Originally designed and constructed by Connolly Brothers in 2001 as a build-to-suit project for Electric Insurance Company, the now vacant building presents a unique opportunity for redevelopment. With its strategic location and existing high-end amenities, Connolly plans to either reposition the property for future tenants or redevelop the site entirely based on market demand. Thad Minshall, Vice President of Real Estate/Development at Connolly Brothers, expressed enthusiasm about the acquisition, stating, "We are thrilled to add 75 Sam Fonso Drive to our real estate portfolio. The acquisition offers multiple opportunities to reposition the property by renovating the existing office building for a new tenant or redeveloping the property as a build-to-suit for a new use." At 38 acres, there are very few sites on the North Shore that offer the same access and lot size required for a significant development. The facility's ideal location offers immediate access to Route 128, close proximity to Beverly Airport, and is within 1 mile of a commuter rail station, enhancing its appeal to a wide range of commercial users. Current amenities include an on-site fitness center with locker rooms, a commercial kitchen and cafeteria with banquet seating, an expansive outdoor patio, basketball court, and ample on-site parking. Connolly Brothers sees the acquisition as both a strategic business move and a reaffirmation of its long-term commitment to sustainable growth and investment in the North Shore region. With its combination of location, infrastructure, and development potential, 75 Sam Fonso Drive is expected to draw interest from companies seeking custom-designed office, research, or industrial space. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoon. See you on the next one.